Hey everyone, it's Young Trader and welcome back to the channel. Today we're diving deep into the world of stock market analysis and investing strategies. Whether you're completely new to investing or you've already dipped your toes in the water, this video is for you. We'll cover fundamental and technical analysis, explore how to read stock charts like a pro, and delve into different investing strategies like growth versus value investing. I'm also going to teach you how to do a basic stock valuation so you can spot potentially lucrative opportunities. So grab your notebooks, get ready to take some notes, and let's get started. Alright, let's kick things off by tackling two fundamental approaches to analyzing the stock market: fundamental analysis and technical analysis. Fundamental analysis is all about understanding the intrinsic value of a company. You're examining a company's financial statements, their revenue, earnings, debt, management team, basically, everything that contributes to their overall financial health. The goal here is to determine if a company's stock is overvalued or undervalued by the market. Technical analysis, on the other hand, focuses on charts and patterns. Technical analysts look for trends, patterns, and indicators that suggest where the price of a stock might be headed. Both fundamental and technical analysis have their own strengths and weaknesses. Fundamental analysis gives you a solid understanding of a company's financial health, which is crucial for long-term investors. Technical analysis, however, is more focused on short-term price movements. It can be a valuable tool for traders looking to profit from quick price swings. The key takeaway here is that you don't have to choose just one. Many successful investors use a combination of both fundamental and technical analysis to make informed investment decisions. It's all about finding the approach that best suits your investing style and risk tolerance. Let's move on to understanding stock charts. Before we dive into candlesticks and patterns, it's essential to grasp the concept of market sentiment. Market sentiment refers to the overall attitude of investors toward a particular security or financial market. It's the feeling or tone of the market, as revealed through the activity and price movement of securities traded in that market. Market sentiment is often subjective, but it can be measured through various indicators. For instance, when the market is bullish, investors are optimistic and confident that stock prices will rise. Conversely, a bearish market sentiment indicates that investors expect stock prices to fall. Understanding market sentiment is crucial because it can influence your trading decisions. For example, during a bullish market, you might be more inclined to buy stocks, expecting their prices to go up. On the other hand, in a bearish market, you might consider short selling or holding off on buying to avoid potential losses. One way to gauge market sentiment is through sentiment indicators such as the Volatility Index, VIX, which measures market risk and investors' sentiments. Another method is to analyze news headlines and social media trends, which can provide insights into the collective mood of investors. By combining an understanding of market sentiment with technical and fundamental analysis, you can make more informed and strategic decisions. Now let's move on to understanding stock charts and their patterns. Now let's dive into the exciting world of stock charts. Whether you're a seasoned trader or just starting out, understanding stock charts is crucial for making informed trading decisions. Don't worry if you're a complete beginner. I'm going to guide you through the basics and show you how to read a stock chart like a pro. By the end of this, you'll feel more confident in interpreting the data and making your own trading choices. The most common type of chart you'll come across is the candlestick chart. It's widely used because it provides a lot of information in a simple, visual format. Each candlestick on the chart represents the price movement of a stock over a specific period, like a day, a week, or even an hour. This allows traders to see the price action and volatility at a glance. A candlestick has a body and two wicks. The body shows the range between the opening and closing prices, while the wicks indicate the highest and lowest prices during that period. The body of the candlestick tells you the opening and closing price of the stock for that period. This is crucial for understanding the market sentiment during that time frame. If the body is green, it means the stock closed higher than it opened, a bullish sign. This indicates that buyers were in control during that period. If the body is red, it means the stock closed lower than it opened, a bearish sign. This suggests that sellers had the upper hand. The wicks, or shadows, show you the high and low prices the stock reached during that period. These can provide insights into the volatility and potential price reversals. Now here's where it gets interesting. By looking at the shape and patterns of these candlesticks, you can start to identify potential trading opportunities. Recognizing these patterns can give you an edge in predicting future price movements. For example, a hammer candlestick, which has a small body and a long lower wick, often indicates a potential reversal in a downtrend. This can be a signal to buy if confirmed by other indicators. Another common pattern is the head and shoulders pattern, which typically signals a reversal from an uptrend to a downtrend. This pattern is often seen as a reliable indicator of a market shift. The key is to learn the most common ones and understand how to interpret them in the context of the overall market trend. With practice, you'll be able to spot these patterns quickly and use them to your advantage in your trading strategy. Now that we've covered some technical analysis basics, let's shift gears and dive deeper into the world of investing strategies. Understanding these strategies can help you make more informed decisions and tailor your approach to your unique financial situation. Specifically, we'll be comparing growth investing and value investing, two popular approaches that cater to different risk appetites and investment goals. Each strategy has its own set of principles and can be suitable for different types of investors. Growth investors, as the name suggests, are all about finding companies with high growth potential. They focus on companies that are expected to grow at an above-average rate compared to other companies. They're looking for the next Amazon, Tesla, or Google companies that are disrupting industries, innovating rapidly, and poised for exponential growth. These companies often reinvest their earnings to fuel further growth. Value investors, on the other hand, are like bargain hunters in the stock market. They seek out companies that they believe are undervalued by the market, often due to temporary setbacks or market overreactions. They look for companies that they believe are undervalued by the market, companies that are trading at a discount to their intrinsic value. This approach requires a deep understanding of a company's fundamentals and financial health. So which strategy is right for you? Well, it depends on your risk tolerance, your investment horizon, and your personal preferences. It's important to assess your own financial goals and how much risk you're willing to take. Growth investing can be more volatile in the short term, but it also has the potential for higher returns over the long term. This strategy is often favored by those who are willing to accept more risk for the possibility of greater rewards. If you're young, have a long time horizon, and are comfortable with more risk, growth investing might be a good fit for you. It allows you to capitalize on the potential for significant growth over time. Value investing, on the other hand, tends to be less volatile and focuses on generating steady returns over time. This strategy is often preferred by those who are more risk-averse and looking for stability. The key takeaway here is that there's no one-size-fits-all approach to investing. Each strategy has its own merits and can be effective depending on your individual circumstances. The best strategy for you is the one that aligns with your individual financial goals and risk profile. Take the time to understand your options and choose the path that best suits your needs. Alright, in this chapter, we're going to roll up our sleeves and learn how to do a basic stock valuation. This is a crucial skill for any investor or financial analyst looking to make informed decisions in the stock market. One of the most common and straightforward valuation metrics is the price-to-earnings ratio, or PE ratio for short. It's a quick way to gauge whether a stock is potentially overvalued or undervalued. The PE ratio tells you how much investors are willing to pay for every dollar of a company's earnings. Essentially, it reflects market expectations about a company's future growth and profitability. To calculate it, you simply divide the current stock price by the company's earnings per share. This gives you a single number that can be easily compared across different companies. For example, if a company's stock is trading at $50 per share and its earnings per share are $5, its PE ratio would be 10. This is a straightforward calculation that anyone can do with basic financial data. This means that investors are willing to pay $10 for every $1 of earnings the company generates. It's a simple yet powerful way to understand market sentiment. Now here's the thing. PE ratios can vary widely across different industries and sectors. For instance, tech companies often have higher PE ratios compared to utility companies. A high PE ratio could indicate that investors are optimistic about the company's future growth prospects, or it could mean that the stock is overvalued. It's essential to consider the context. Conversely, a low PE ratio could suggest that the company is undervalued, or it could signal that investors are concerned about its future earnings potential. Again, context is key. It's important to compare a company's PE ratio to its peers in the same industry and to its historical PE ratio to get a better understanding of whether it's truly overvalued or undervalued. This comparative analysis can provide deeper insights. By using a combination of valuation metrics and your own judgment, you can start to identify potentially undervalued stocks and make more informed investment decisions. Remember, no single metric should be used in isolation. Always consider the bigger picture. And finally, let's wrap things up by comparing two popular investing approaches: long-term investing and day trading. Both have their own unique advantages and disadvantages, so it's essential to understand the key differences before you dive in. Long-term investing, as the name implies, involves buying and holding stocks for an extended period, typically years or even decades. It's a strategy that focuses on the fundamentals of a company and its long-term growth potential. Long-term investors often reinvest their dividends, allowing their investments to compound over time. Day trading, on the other hand, is all about profiting from short-term price fluctuations in the stock market. Day traders typically buy and sell stocks within the same trading day, aiming to capitalize on small price movements. It's a high-risk, high-reward strategy that requires significant time, skill, and discipline. Long-term investing is generally considered less risky than day trading. It's a more passive approach that doesn't require constant monitoring of the market. And historically, the stock market has trended upwards over the long term, rewarding patient investors who stay the course. Day trading, however, can be incredibly stressful and emotionally draining. The key takeaway here is that there's no right or wrong answer when it comes to choosing between long-term investing and day trading. So there you have it. We've covered a ton of ground today, from fundamental and technical analysis to stock valuation, investing strategies, and even day trading. If you found this video helpful, please give it a thumbs up and subscribe to the channel for more investing insights and tips. And don't forget to hit that notification bell so you don't miss any future uploads. Thanks for watching, and I'll see you in the next video.